Well, let's look a little closer at China because one of tonight's guests brought out some very positive news only this week about what trade with China is doing for Australian households. I'm joined now from Perth by Frank Tudor, chairman of the Australia-China Business Council, and also here in the studio by Steve Johnson from Intelligent Investor. Gentlemen, welcome.
Thanks, Diggy.
Thank you. Frank, in Perth, if I can go to you first, start with the bull. You released, as I say, this week data on how the Aussie household benefits from China, and you're actually pretty optimistic about the fact that China's going to continue to deliver for us.
Yes, we are. Look, we produced a report which sought to take the high level of trade and investment between the two countries, which is running at over $100 billion a year, and sought to quantify that to the household level, where it's estimated to be about $13,500 of benefit to the average Australian household. Now, that's based on last year's figures, and it's increased dramatically over the last couple of years. And in terms of the prospect going forward, I think there's a number of factors which I would turn to suggest that China will continue to actually grow at a pretty respectable rate. I think the issues related to their form of government, which is a form of state capitalism, I think allows them to actually implement policy directly through, such vehicles as their state-owned banks. So that is important in the context of being able to deal with monetary policy. The other important factor, I think, is that, the state of the banks is healthy. They've got a healthy balance sheet. And in terms of what the government can call on, they've got something like $3 trillion of exchange, which they can use to actually drive economic growth if they need to.
All right, well, let me pick you up there. I'll turn to Steve Johnson because you're a little bit more wary about how robust and sustainable China is. Are these banks in good condition?
Well, they are at the moment, but the US banks were in very good condition before the housing crisis struck over there as well. A bank's balance sheet will normally look at its absolute best right before a crisis hits because the times are good. I think everyone's in agreement that China will continue to grow over the next 10 or 20 years. The big question is whether that growth will continue anywhere near the rates that we've seen in recent years. The Chinese Premier has himself described the growth over there as unsustainable, uncoordinated, and I think that's a very good way of thinking of it. The level of investment in infrastructure over there that's been driving the GDP growth is what really concerns me.
This issue of China being an investment society rather than a consumer society, I know you've got a quite handy little graphic which we might actually put up there for our viewers. Can you run through through us what that graph actually shows and what its impact is?
Well, what we've got here are the four components of GDP in any economy. You've got government spending, you've got net exports, you've got investment, and you've got consumption. And the big green line you can see on the screen there is the level of investment, and particularly over the last 10 years, you've seen it go from about 35% of GDP to now being 50% of GDP. And the converse of that is that consumption has gone from 50% of GDP down to the mid-30s. Everyone agrees that's unsustainable. The question is how you get from where it is now to sustainable growth without having some sort of crisis in China.
Frank Tudor, do you agree with that analysis?
Look, I think the facts in terms of the graph, which I can't see, I would probably agree with. The point that I would make is the fact that the current and the pending leadership in China have recognised that the economy is overheated, and they've actually taken steps already to bring inflation into check. And they've also already looked at the 12th five-year plan, which is talking about bringing a quality dimension to the growth which they haven't had before. So they are focused on bringing more inclusive. They're focused on actually the environment and making sure that those externalities are priced into their growth. They're also looking at actually bringing the western part of the country, which has been largely ignored through the current urbanisation process and prosperity process, into the mix. So I think the recognition that they've put on that demonstrates that they're confronting the problems. And as I say, they have got the tools at their disposal to actually make a difference.
Yeah. Well, Frank, I noticed last week ANZ put out some numbers about property investment, that indeed property investment should remain solid and that public housing investment will offset the shortfall in any private housing investment reduction. Do you also see that Australia will benefit going forward from a gradual recovery in Chinese demand for Australian resources?
Well, yes, undoubtedly. The urbanisation process, which obviously started on the eastern seaboard, has got a long way to go before it actually encompasses the entire country. It's only about 50% of the population that have enjoyed the urbanisation process and the prosperity that comes from that. And through this last 5-year plan, there's a very deliberate approach taken to taking that out to the interior and the western part of the country. And as that happens, of course, the urbanisation program continues, and the real estate that is built to actually house these people represents about 40% of the steel demand in China. So that clearly will translate to continuing demand for our iron ore and other natural resources.
Steve Johnson, if China does succeed in which I think you think it will push towards a consumer society, away from an investment-driven society, are you still worried about what that will do to demand for resources? Because I don't think you're as positive as Frank, are you?
Well, absolutely not. And I think even that idea that you can just shift to a consumption-based society, it's like trying to tow a 2-tonne caravan with a 2-cylinder car. Because consumption has become such a small percentage of the economy now, at 30%, you need it to grow at twice the rate of investment to compensate for any reduction in the rate of investment. And I think on the housing front, there's more than a year of unsold inventory of houses in China, and there are plenty of stories over there of people buying houses that they don't even intend to rent out. They buy it for an investment purpose. They intend to sell it down the track. And there are increasing signs that that housing bubble that they've had over there is coming unstuck, and that the government is not actually that interested in house prices still going up because it's becoming unaffordable.
The political unrest that has surfaced as well.
Well, there's a lot of issues there, and I do think that the government will do everything they can this year to keep the economy going, and that will probably mean that they will invest even more into the investment side of the equation this year, because they do not want to go through a leadership transition with the economy in the doldrums. So I think you'll see a lot of efforts this year to keep the economic growth going. I'm really worried about 2013 and 2014.
Frank Tudor, you say that Australia is pretty unique amongst industrialised countries in being a net exporter of commodities and a net importer of manufactured goods. I mean, that is wonderful for our consumers, not so good for our manufacturing industry, of course.
Yeah, well, the demise of the manufacturing sector has not, I don't think we could attribute that to China. We started a trade liberalisation program under previous governments back in 1988, and I think prior to even China becoming a booming prospect for us, we'd gone from about tariff levels of 15% to about 3% currently. So that already brought around structural change.
Surely our resources boom and the rise of the Australian dollar has contributed some very big challenges for our manufacturing industry.
Yeah, look, undoubtedly, but I think a lot of the structural changes had already taken place. So I think economists have generally agreed that, further structural impact will be there, but it's not going to be anywhere near as significant. But look, I think the other way to look at it is if we didn't have the commodities and we didn't have the Chinese demand and we didn't have the income coming from China, what would the economy look like without that? Because I think our manufacturing sector is nevertheless exposed to global competition, which is coming from China but also outside of China.
Right. Steve Johnson, as investors, should we be preparing for a China crisis? And if we wanted to do so, how should we prepare for it?
I think the issue that I think a lot about is, even if I'm wrong, what is an appropriate level of exposure for an Australian to have to China and the growth that's coming from over there? Your job's probably exposed to it. The level of government spending here in Australia is exposed to it. The stock market is more than half resources stocks now. So I always say to people, just have a think about managing your risk and how you should try and reduce some of that exposure to China as an Australian investor. For me, there are some very big, good exporters here in Australia that are not resources stocks, the likes of QBE, CSL, that have been fighting a rising currency that represent a very, very good hedge against the benefits that we're undoubtedly seeing from China at the moment.
Frank Tudor and Steve Johnson, thank you very much for joining us tonight.
Pleasure.